going. So Mike, everyone, we have a great program today. So Mike's going to talk with us about the stock market. Obviously, it's a very interesting time to talk about that. So Mike, would you like to go ahead and get started?
Oh, sure. Hi, guys. How you doing?
Hello, Mike.
Here we are again. What's the old Chinese proverb? May we live in interesting times. What I thought would be interesting to give a little context to our discussion this morning. I thought we would kind of go back and kind of compare where we are now to when we last talked back in March. And then we can kind of talk about, well, where we go, where do we go from here, and what do we expect to happen from here? So let me kind of go back for a minute and just kind of revisit where we are now versus where we were when we last talked in March. In March, the Fed expected the U.S. economy to grow at about a 2.8% rate. They haven't revised their estimates for GDP growth this year yet, although they might do that at their meeting today and tomorrow. We'll have to kind of listen to see what they say. Back in March, the IMF thought that global growth would be about 3.6%, and the World Bank thought that global growth would be about 3.2%. Just recently, as of last week, both the IMF and the World Bank lowered their global growth forecast by 0.3%, and they're kind of looking at what's happening in China and in the war in Ukraine and the big rise in oil prices is continuing to slow down economic growth this year. Back in March, the U.S. unemployment rate was 3.8%. Today, it's 3.6%. The labor force participation rate back in March was 62.3%, and now it's 62.4%. So more people are going back to work. And wages were up 5.1% back in March, and annual raises now are up 5.2%. So the economy is continuing to add jobs, and wages are continuing to go up. The purchasing managers indexes for both the service sector and the manufacturing sector were up in the high 50s back in March, which showed pretty good growth in the economy. Now, those numbers have backed off a little bit to the mid 50s, but the mid 50s are still good, which continues to show good economic growth here in the US. Let's see. The Omicron variant has subsided. Most of the restrictions here in the US have been lifted, and the economy here is starting to reopen. Now, obviously, in other places of the world, that's not the case, particularly China, which is the second largest economy in the world. Retail sales have continued to be strong. They were strong back in March, and they're strong, even stronger now. And remember, the consumer is 70% of the U.S. economy. So the consumer is buying. People have jobs and they have money. The Russia and Ukraine war had just started, and unfortunately, it continues to rage. Oil was at $100 a barrel. Now it's close to $120 a barrel. And interestingly, now that the first quarter's earnings have ended, 79% of the companies in the S&P 500 that reported earnings from the first quarter, they beat their estimates by about 4.9%. So corporate earnings were pretty good in the first quarter, and 74% of the companies in the S&P 500 beat their revenue estimates by about 2.7%. And interestingly, analyst estimates for S&P 500 earnings for 2022, which were $225 a share at the beginning of the year, are now $230 a share. So analysts have, after the first quarter results, have actually increased their estimates for 2022 earnings. That kind of puts the forward PE multiple on operating earnings based on today's prices at a little under 17 times. That's down from 18.5 times in March. and 21.5 times since the beginning of the year. So, the economic indicators are looking pretty good, but we all know the market's not doing very well. The NASDAQ is down about 30%. The S&P is down about 20%. Bonds are down over 10%. Commodity, it's crazy. Commodities are up 40%. So it's crazy. The economy looks, the economy looks good, but the market's crummy. What's going on? Well, a couple other things I think are important to kind of give an explanation of why that's happening. The consumer price index back in March was 7.9%. Again, pretty high rate, 40-year high. But just last week, we got a number that came up at 8.6%. So inflation is continuing to rage and it's getting worse. The producer price index, the wholesale price index, which came out this morning, was 10.8% year over year. That compares to 10% back in March. So inflation is continuing to, it's still here. It's persistent, and it's persistent at a very high rate and increasing. The 10-year Treasury rate was at 2.15% back in March when we last met. Yesterday, it was at 3.37%. It's a 50% increase in the 10-year Treasury rate. And that's an important rate because that's the discount rate that a lot of investors use to value assets. So that kind of explains what's going on. The Fed back in March, remember, hadn't yet raised interest rates when we last met. Now the Fed funds rate has gone from 0 in March up to 75 basis points. The Fed was talking about doing quantitative tightening. Remember, they have a $9 trillion balance sheet, and they were talking about reducing the size of that balance sheet beginning in June. Well, they've just started this month to reduce their balance sheet by $47.5 billion a month. And they expect to increase that, at least at their last meeting, they said they were going to increase that to $95 billion a month in September. So the Fed's done a lot of talking about what it plans to do. It has done a lot of talking about, gee, we're going to do whatever it takes to get inflation under control. But so far, they haven't done a whole lot, okay? Now, they're meeting today and tomorrow. The expectation is they will do something else. They said they were going to, at their last meeting in May, they said they were going to raise rates 50 basis points this meeting, 50 basis points in July, then take a pause and see what happens, and then decide what they're going to do in September. Well, the inflation data has continued to get worse. So there's a lot of talk and concern among investors in the market that the Fed may have to do more than they originally thought. And maybe they have to do so much that they throw the US economy into recession. That's why the market's acting the way it is. The behavior is not unusual in a Fed tightening cycle. If you kind of you look at history and look what happens to the stock prices in a Fed tightening cycle, the same kind of things have happened in the past that are happening now. Remember discounted cash flow. It's a very important concept. All asset prices are priced at discounted cash flow. You look at a current rate of interest, look at future estimates of earnings and discount those at a current market rate. As rates go higher, asset prices drop. All asset prices drop, okay? Just some drop more than others, okay? So it's important to understand that concept. Let's talk a little bit about the price earnings ratio. Remember, there's two elements to that. There's the price and the earnings. As we talked about before, the price earnings ratio at the end of the year was 21.5 times. The 25-year historical average is 15.5. But remember, interest rates, Fed funds rates were 0 back at the beginning of the year. They were 0 in March when we last met. The Fed talked about raising rates, so the discount rate, the multiple dropped from 21.5 times at the end of the year to 18.5 times in March to just under 17 times now. So the market's anticipating higher rates, and indeed the 10-year Treasury's gone up. So that's why multiples have compressed. The other thing that the market looks at is earnings. As I just mentioned, analysts have raised their earnings estimates for 2022 to $230 a share. And that's how you get to the current S&P price of about 3,900. What happens if earnings estimates go down? And we've heard reports from Target and Walmart that they're having problems passing on a lot of these prices. We've heard discussions from other big tech companies about what their earnings are and how they're being impacted by the increase in the dollar overseas. So are earnings really going to be $230 a share this year? A lot of investors are skeptical that those numbers will hold up. What do you think is going to happen to stock prices if the E in PE drops? Just think if at a multiple of 17 times, the earnings estimates drop from 230 to 220, $10 a share, how much will the S&P go down? 170 points. What if they go down $20 a share? That's 340 points from here. So we have to watch and see what companies report on their second quarter earnings, which are coming up in a few weeks, and see what their guidance looks like. So the market's anticipating that, we might go into a recession and earnings are going to have to go down. I also think it's important to note, based in history, when the Fed starts raising rates, it normally takes, say, 9 to 12 months for those rate increases to be fully reflected in the economy. Now, the Fed just started raising rates in March, and it raised it another 50 basis points in May. So it hasn't done a whole lot yet, and it's just begun quantitative easing. So the full impact of the rate increases probably isn't going to be felt till sometime in 2023. So again, just kind of my view of that is that the rates don't get into the economy fully reflected until 2023. So the likelihood of a recession this year is it's possible, but low. And it's a much higher probability next year when the full impact of the rates is known. But even the Fed doesn't know how high they're going to have to go and how fast. Right now, they said they wanted to get the Fed funds rate to something slightly above neutral, and defining neutral as something that's neither accommodative or restrictive to help slow down inflation. And that's somewhere between 2.5% to 3%, depending on who you ask. Well, if inflation raging as much as it is, and the numbers that have just come out today and on Friday, a lot of investors are thinking maybe the Fed, you're going to have to go a little higher, to get inflation under control. So what that means that the price earnings multiple has to come down a little bit. And if the economy does go into recession, then earnings are going to have to come down a lot too. The earnings estimates for 2023 are $250 a share on the S&P 500. So you can kind of get an idea what the potential risk is if earnings estimates come down and analysts start to ratchet those down. That's what's causing all the market volatility. The volatility, again, is normal, and that's typically what happens when a Fed starts in a rate tightening cycle. Unfortunately, we have a couple other exogenous events that are going on that are putting restrictions on supply, which is exacerbating the inflation problem. Remember, and that's the war on Ukraine and the shutdowns in China, because China is basically shut down because of an outbreak of coronavirus. And that's really restricting supply. Then you also have restrictions on supply of food and energy because of the Ukraine war. But also the money supply, M2, the money supply is 40% higher today than it was in March of 2020. And what we all learned from our economics classes in school, Economics 101, the principal definition of inflation is too much money chasing too few goods. With a money supply that's 40% higher than what it was 2 years ago, that's a big contributor to the inflation. That's the primary contributor to the inflation. The supply chain restrictions just exacerbate the inflation problems. Hopefully those will go away soon. Get my fingers crossed, okay? We don't know. We'll have to see. So, as I mentioned before, the S&P was only down about 10% in March. Now it's down 20. The NASDAQ was down about 20% in March. Now it's down 30. Bonds were down about 6% in March. Now they're down over 10 because interest rates are way up. Commodity prices are up 40%. The dollar's up 8%. I mean, at least the U.S. has started to raise interest rates. Interest rates in the European Union and Japan haven't gone up at all. They still haven't raised their rates. And as a result of all that, the economic growth here in the U.S. is stronger. We don't have a war raging here. And our Fed has started raising rates. As a result of all that, the dollar has rallied. Unfortunately, that has a negative impact on the earnings of U.S. corporations that have a lot of sales overseas when they get translated back into U.S. dollars. So that's hurt U.S. corporate earnings. We'll see what happens. Let's see what else. What stocks have done the best? Well, obviously the stocks that have done well are things that are, lower price earnings multiples. Stocks that healthcare stocks, things that are kind of not economically sensitive. So healthcare stocks has done well. Energy stocks have done the best. They've kind of knocked that out of the park. Can you remember back 2 years ago when oil was negatively priced right after the pandemic? Now it's $120 a barrel. Yikes. Remember everybody said oil was not investable? Guess what? So energy has been the best performing asset class. Healthcare has done well. Material stocks have done well. Utilities and consumer staples have done well. Things that are, they have pricing power. Companies with good brands that can raise prices, okay, and basically maintain their margins. The kind of stocks that haven't done well are stocks with high price earnings ratios, or high price to sales ratios and no earnings. And that would be a lot of the newer tech companies who's have a lot of promise, but no earnings right now, or biotech companies in a similar place. Those stocks have gotten clobbered. Some of those are down 60, 70, 80%. Yikes. That's why the NASDAQ is down so much. And most of those stocks, trade on the NASDAQ. And that's why the NASDAQ is down a lot more than the S&P 500 and even the Dow. Consumer discretionary stocks have not done well. Obviously, if investors think we might be going to recession, those have gotten hit pretty hard. Auto companies, a lot of retailers. Let's see what else has not done well. A lot of things. So that kind of gives you an idea of what's done well and what's not. And until we really kind of see the Fed giving some indication that it's close to being near the end of raising rates, which they're just starting. Okay, until we hear the Fed say, we're getting close to the end, we think we got inflation under control. Until China starts to reopen, until the war in Ukraine ends, I think the market's going to continue to be as volatile going forward as it has been now. So what do we do? Good question. Expect more of the same. Expect continued volatility until we get some better information on, what the Fed's going to do, China reopening and the war in Ukraine. Those are the three big uncertainties that are kind of, driving investors' behavior right now. And expect the same kind of things that have done well recently to continue to do well. The same kind of stocks that have done poorly to continue to do poorly. Now, hopefully, everybody on this call has their retirement money that they're relying on invested in a well-diversified strategy and is doing, basic strategic asset allocation. The types of investments we're talking about making here are really for our mad money. okay? None of us should be trying to time the market because you'll never get it right, so don't. But if you got a little cash on the sideline and you're thinking about what to buy and what not to buy, focus on the kinds of things that have been doing well. Energy should continue to do well. Healthcare should continue to do well. It's not economically sensitive. Utilities can pass along the cost of higher energy prices, so they should continue to do well. Consumer staple stocks or companies with good brands and can pass along, have pricing power, can pass along costs, should continue to do well. The high PE tech stocks and biotech stocks should continue not to do well. So don't put money in that stuff yet, okay? Until we get some indication from the Fed that they're close to being near the end. And I don't expect that to happen anytime soon. Let's see. Let's just stop there for a while and kind of open it up for questions and have a discussion, because these discussions are always fun that we have. Is that enough to get conversations going? Who wants to be first? Bill Livingston has his hand up.
The market has been declining for some time,
right?
But we're reading now, we're entering a bear market. What is the definition of a bear market and conversely of a bull market?
Well, a bear market is one, it's down 20% or more, okay? Now the S&P just technically entered a bear market, okay? Now the NASDAQ's been in a bear market for a long time. The NASDAQ's been down more than 20%, probably since the beginning of the year. The S&P just went down 20%. So on the technical definition, we're in a bear market. Depending what stocks you're in, you may be in a double bear market, okay? The bull market is when the pain stops and the market starts to recover, okay? So we're in a bear market right now. You have periodic bear market rallies. Use the bear market rallies to raise cash, okay? Because having a little cash in a bear market's not a bad thing, because you get an opportunity to buy good stuff cheaper. And again, don't fear bear markets. The reason that stocks give you a 10% return over the long run is because they are more volatile. The volatility provides the opportunity for us, to get those higher returns we all need. Okay, so don't fear volatility, embrace volatility and take advantage of it. I mean, it's always a good idea to have a little cash on the side to take advantage of dips when they occur. You never know when the bottom's going to be. So have stocks on your radar screens, and when they get down to a target price you like, buy them, and then be patient, because the volatility will end at some time. You look at history and the volatility always ends. I mean, the financial crisis in 2000, 2008 was very painful when we all went through it. The S&P was down 56%, but guess what? Governments change policies, corporations change practices, and the markets rally. And we've enjoyed a nice bull market since then. The tech bubble burst in 2000 to 2001. Stock prices dropped 50% again. But again, policies changed, government policies changed, corporate policies changed, and the markets rallied. And you look back in history, and that's occurred every time. Going back, looking at the past 100+ years, going back to the 1920s when the S&P 500 was first put together. Bear markets end. Policies change, bear markets end. So don't fear volatility. It's temporary. It could last a year, maybe 2 years, but it is temporary. Even the Great Depression ended, okay? So don't be afraid of volatility, guys. It's normal. And that's the reason we get the returns on stocks that we all want. More questions. John, you had your hand up. You're on mute, John.
So could you talk about I bonds and
Yes.
their place in a portfolio?
Well, I bonds are a great fixed income investment. They're issued by the U.S. Treasury, and you have to go directly to the Treasury's webpage to buy them. But you can only buy $10,000 worth, and they have a very high interest rate on them, like about 9 or 10%. So you can buy 10,000, and your wife can buy 10,000, and that's about it. They're great They should allow everybody to buy more, but they're a good investment. If you have an allocation to fixed income, take advantage of it, but you can't buy a lot of them. So let's see, Harvey.
No,
Thanks for your,
oh,
thanks,
go ahead.
thanks for your presentation. My question is this: I had always heard that rising interest rates are good for bank stocks, but that doesn't seem to be playing out now. Could you comment on that?
Sure. Again, many investors think we might be going into a recession. And if we go into a recession, they're fearful that banks will have credit issues. People won't be able to repay their loans. That's why the bank stocks haven't reacted the way they have. Typically, when the Fed starts raising rates, the interest margin that the banks make on loans goes up. So that's why bank stocks are typically rally in a rate rising environment. But the inflation is raging so high, and people think the Fed's going to have to do a lot more than the Fed currently thinks it's going to need to do. And that's going to cause a recession, which will cause credit issues. So borrowers may not be able to repay their loans. So investors, that's why bank stocks haven't done as well. But there are other types of financial stocks that do well. Think about an insurance company, for example. When interest rates go up, what happens to the liabilities that are on an insurance company's balance sheet? Those liabilities go down because they're discounted. Those future claims are discounted at a higher rate. So the liabilities go down on an insurance company's balance sheet. They go down more than the value of the assets that it invests. So insurance companies might be a good place to go. In terms of financial stocks, insurance companies benefit really a lot in a rising rate environment. It's another place to look, and they typically pay good dividends too. Norman?
Are floating rate funds good right now as interest rates are rising?
Yes. You got to buy high quality ones. Okay, there are a lot of funds that invest in floating rate bonds that have investment grade notes in them, typically issued by major banks. Those interest rates in those notes will go up as interest rates rise, and they reset on a frequent enough basis where you don't have a lot of principal risk. But there are also some floating rate funds that invest in really crummy, but the notes are really crummy companies. So you gotta watch and see what they invest in. If it's high quality, good credits, then floating rate notes make sense in a rising rate environment. Something else to consider are bond ladders. Does everybody know what a bond ladder is? In a bond ladder, let's just do a typical example. You buy bonds and you kind of spread out the purchases. So you have, say, you do it over 10 years. You have 1/10 of the bonds maturing in a year, another 1/10 of the bonds maturing in 2 years, 3 years, 4 years, and so forth. So you build the ladder out and you lock in your total return when you buy the bonds. And as the bonds mature, you reinvest those proceeds into a new bond. So you climb the ladder as interest rates rise. Because you're locked in and your strategy is to hold the bond to maturity, even if interest rates go up and the price fluctuates while you're holding the bond, you're always going to get par back. So you're basically locking in your total return when you buy the bond. Then you climb the ladder when you reinvest those proceeds when they mature every year. So take a look at bond ladders as well as a way to mitigate the risk from a fixed income portfolio.
Okay, thanks.
Okay, who else? Irv? You're on mute, Irv. Irv, you're on mute. Irv, you're on mute. Unmute your phone. Irv? Look on the bottom left-hand corner of your screen. There you go.
I think I got, can you hear me now?
You got it. Okay.
Okay. I asked my broker about some of these analysts are calling like lows. So S&P, they're saying 3,500, and gets to that, then you can go back in the market and so forth. And he said something that you were talking about. He refrains from predicting a low. He says he watches the volatility. He says, as long as the volatility's up, you're better off playing it cool as far as new investments. And also, I get a letter from a fellow named Brian Westbury. He's supposed to be pretty good. And I got one yesterday, and he talked about this money supply.
Right.
He said the date to keep an eye on, besides what the Fed does tomorrow, is June 28th at noon. That's when they come out with the, I don't know if it's a monthly deal or what, but that's when they come out with that money supply report. And he said the same thing you did. The more money supply, the higher the inflation goes, and vice versa.
Well, obviously, if he agrees with me, he's a smart man. No, Brian Rustberry is a very well-known economist from First Trust, and again, he's just repeating what we all learned in college in Economics 101, that inflation is primarily a monetary event. I mean, we all know that, except the people in Washington, apparently. Now, let's see. That's not Myra. Okay, but you can talk. Go ahead.
I'll talk for Myra anyway.
Thank you. Please talk for Myra.
Myra, you need a shave.
The Fed has, I think, 9 trillion on its books. I think in my lifetime, I've never seen anything like
That's
this.
a lot of money.
That's a lot of money. And now they want to start quantitative tightening, not
Right.
easing. Now, the question is this wise to start selling all of this into a down market? I mean, or should they wait to start dumping all this stock into? Does it make a difference?
Again, all the money they printed is sitting on their balance sheet. Okay, I mean, they went out and borrowed, to fund all this stuff, and that's caused the inflation. And so they're doing it at what they say. I think it's a pretty measured pace. It's only 47.5 billion for the next few months, and then they're going to increase it to 95 billion. But they're moving slow to see what happens, because they have the same concern you do. How's the market going to react to this? So
yeah, that was one of my concerns.
Yeah. So the answer is, yeah, it'll have an impact. They're not sure what it is yet, but they're just going to watch and see what happens.
I think a lot of us had predicted that this would happen a year ago when
Sure.
Biden was passing out money like water and giving. I mean, I said a year or 2 years ago, this is craziness, printing this money. I said it has to cause inflation, and I would imagine that this is one of the primary causes of what we're in today.
Absolutely.
Now the other thing is, he says he's going to raise interest rates 0.5 Wednesday. Some people say 0.75, and then
Right.
another one. And then he says he's going to pause in September. Well, the reason he wants to pause in September is because there's an election coming up, I think. And so is the Fed going to be
inject politics into this conversation, because that's not a winner.
because every time they don't want to influence the election, so this could slow them down. So what I'm thinking is maybe instead of 0.5%, they're going to go to 3/4, because they know that they have to pause in the fall because they don't want to influence the election and make it
Right.
I don't know what they're going to do. We'll find out tomorrow whether it's 0.5.
Right. We'll find out tomorrow. Let's see. I see a number, but not a face. That's
me, I think.
Is that
Okay.
2348?
Meryl, yes.
Go ahead. Ask your
I
question.
just read an article this morning that some people are saying to replace, wonder what you thought about this, Janet Yellen with Lawrence Summers, number one. Number two, most analysts I've talked to say, hold on to your cash. But it seems to me the stocks that are doing so well because people are traveling and spending their money are the hotel stocks, the cruises are coming back, the airlines are profitable, those kind of stocks. And what's amazing to me, just briefly, is how the poor can't afford medicine and so forth and so on, but the very rich don't know what to do with their money, and they're just spending, saving it. I'm not criticizing, but it's really unbelievable to me that there's no middle point. There's such a disparity there.
Yeah, with regard to your question about replacing Janet Yellen, I really don't have any comment on that. I don't think that's going to change the inflation picture any, because it's the Fed that basically controls the interest rates, not the Treasury. So I don't think that would have a big impact one way or the other. And your comment about the poor being the ones that are hurt the most by inflation is absolutely true. If the economy goes in the recession, they'll be the first people to lose their jobs. And they're also the ones that are least able to afford the higher prices for food, gas, and medicine. You're absolutely right.
Yeah.
In terms of the stocks to buy, again, the types of stocks that have done well are healthcare stocks, utility stocks, material stocks, energy stocks. Those are the stocks that have done well and should continue to do well in this environment. Clearly, the economy is reopening, and people will buy more services, and we've seen a shift in what people are spending money on. They were buying a lot of goods during the pandemic. Now that we're coming out of the pandemic, the restrictions have been relaxed. People are buying more services. Services include travel. But the travel stocks ran way up in anticipation of that, and they're getting clobbered right now too, because they think that people may be able to take one trip, then they won't be able to afford to take another one. But again, consumer balance sheets are also very strong. People have a lot of cash. I mean, one, they got a lot of checks from the government, so they're sitting in their bank account. They weren't able to travel or do anything, and they've got jobs. Okay, so they've been able to save a lot of money. So consumers have a lot of cash. Okay, so they can spend it. Now they have to see that they're going to probably spend more on services like going out to restaurants and traveling. But again, a lot of those stocks ran up already in anticipation of that. Who's next?
Can you answer one last question?
Oh, go ahead.
Are the I-bond, because I'm not familiar with this, and you said they pay 10%. Are
Right.
I-bonds safe? Would you recommend putting?
They're issued by the United States Treasury. They're safe because the government can always print money to pay them off. So you know you're going to get your money back.
I see. So each person in the family then could buy an I-bond for $10,000. Is that
Right.
correct?
That's right.
Huh. Okay,
That's right.
I
But you have to
understand.
buy it directly from the Treasury. You have to go to their website.
All right, I understand. Thank you.
Okay. Let's see. Irv, you have your hand up again.
You mentioned about the pandemic slowing down. I'm saying that it's not slowing down so much. We just went to a wedding in Kansas City, and after the bride and groom in the email invitation, everybody to certify that they've been vaccinated and boosted before they would come. And after the wedding, they both got COVID, the bride
Oh,
and
that's terrible.
so I'm seeing that it's picking up again in a lot of places.
Well, as the economy reopens and the restrictions have been dropped, people are getting back together again more. So there has been an increase in cases, but not to the level it was back in the winter.
Well, I see where they made it more or less optional on airplanes. I wouldn't get on an airplane unless I was wearing a mask.
No, I understand. And remember, China's locked down because they have a zero tolerance policy, and that's really putting restrictions on the supply chain, which is exacerbating inflation. Let's see. Who else has a question here? Yeah.
Steve Rudinsky's got a question.
He
Oh,
always
and
has a
Maryland's
question.
no, I put.
Or he
my
has a
hand-
comment.
No, I didn't take my hand down from before.
All right.
Oh, okay.
Well, looks like Maryland's hand is still up. I don't know if she still has a question or not.
Marilyn, go ahead. Marilyn, you have a
Sorry,
question?
it's not. It's not.
Okay. Again, guys, I don't think if we're going to have a recession, I don't think it's going to be this year, because again, it takes a while for those higher rate increases to get in the economy, and the Fed really has only just begun. So maybe the middle of next year we might get a recession, but that's not for sure either. We'll see.
What about the word stagflation? I've been reading that. That's sort of been mentioned.
Everybody remember the 1970s? We're all old enough to remember the 70s, where we had high inflation and no growth, and
Right.
stocks. The 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 Dow Jones stayed at 1,000 for like a decade. That's a horrible scenario. I hope that doesn't happen, but that's certainly a risk. Okay, if we don't get inflation under control and maintain growth, we'll see.
Yeah.
Again, anybody that tells you they know what's going to happen in the next 6 months is nuts. Okay, because nobody knows. Even the Fed doesn't know what it's going to have to do. So we'll have to go to watch it and see.
Would you personally buy Apple stock? It's down to 132, which is unbelievably low.
Well, you know, Apple's certainly a very good company, a very strong company, and will survive any recession. You know, I'm not a stock picker per se, but it could go lower. Okay, because its price earnings multiple is not that low. It's higher than the market multiple. Okay, so it's certainly at risk if interest rates go up. Remember, rising interest rates negatively impact all assets, all, ALL, okay? Those with the highest PE multiples get whacked the most. So look at the companies, look at their balance sheets, make sure they have good cash flows, make sure if they pay dividends, that's great. Make sure they have pricing power, okay, and aren't too highly leveraged. You want good quality stocks will hold up and survive any recession. Apple is a good one. You know, can the price go lower? Sure it can. Could go higher too, eventually. John.
Yeah, well, could you tell me a little bit about, you mentioned that, you know, automobile prices, stocks are adversely affected. But, you know, with the energy crisis, we've got the electric vehicle and we've got alternative power sources, and we have the lithium, which is a mineral which is important to batteries and creation of battery. That whole power and electric vehicle. Can you want to comment on that area of the investments?
Sure. I mean, there's clearly the current administration is very clean energy oriented, and a lot of companies are investing in clean energy. But again, you got to look at the individual companies and see what their valuations are. Okay, and also remember too, you know, it takes a lot of lithium and other minerals to build electric vehicles. Things like lithium, nickel, etc. None of which are produced here in the U.S. You know where most of that stuff is produced?
Afghanistan,
Russia, China. Okay, so we're putting our energy. Me personally, our energy policy doesn't make sense because the stuff we need to be more clean, a lot of the materials are produced overseas by people who don't like us. So that to me that's something to worry about. Okay. Plus, you can't go from zero fossil fuels, which make up 80% of the power we get today, to zero overnight. You got to have a policy that allows for an orderly transition. Okay, and that policy I think needs to change so that we can have an orderly transition to clean energy. It's kind of nuts. And then people going to be able to buy or afford the electric vehicles? I mean, the government wants to give credits to people to buy electric vehicles. That's going to be hard to get through Congress because that's a lot more money. So, yeah, I hear all the hype and the excitement, and it's probably going to happen, but it's going to happen over a long period of time. And again, I wouldn't abandon fossil fuels either, okay, because we're going to need them for a long time. Plus, there's a lot of other stuff that's made from energy. I mean, and oil goes into almost everything we buy. So clean energy, it's got good potential. Pay close attention to the valuation of the individual stocks. Again, if they don't make money and they have high PE ratios, don't buy them. They're not going to do well in this environment. They may do well long term, but not now. Again, look at the individual company. Harvey?
It would seem that in the case of rising interest rates, which we're going to face, you'd be better off buying into companies with little or no debt. How do you determine the debt levels of companies and locate low debt companies?
Look at their balance sheets. Everybody know what a balance sheet is? The balance sheet shows what the assets and liabilities of every company are. You can go on to Yahoo Finance and type in the ticker symbol of any company you're interested in, and you can pull up their balance sheet and look and see how much debt they have. If they have a lot, excuse me, got to take a drink first.
Mike,
If they have a lot of debt on their balance sheet that's coming due in the next couple of years, you got to scratch your head and wonder, okay? So look at their balance sheets. Irv, question.
I was just gonna mention, if anybody's thinking of flying in the next few months, you ought to go ahead and get your ticket. We were looking at tickets to Chicago about 3 weeks ago. I didn't buy them right away. I went back and got them last week. They paid 10% more than what they were quoted 3 or 4 weeks ago. The fares on these airlines are going to go up by leaps and bounds.
Oh yeah, inflation is going to be persistent, guys, and be around for a while. Again, no, the Fed has said it'll do whatever it takes, but will they? We'll have to watch and wait and see. Go ahead, Steve.
Just recently, a few days ago, one of the big crypto firms had a problem. They couldn't redeem their.
Only one?
Well, I mean,
several.
Okay, several. And we had a kind of a dip in the crypto, and I've noticed that the stock Square, or now called Block, also has gone down in relation to the scare in the crypto market. I've always been skeptical of this whole crypto thing.
You should be. You should be. Okay.
But I was wondering, well, if this crypto thing crashes, what effect would that have?
It will impact the I'll call it major institutional investors that are involved in that market, but that's not going to have a material impact on the economy because that market's still not that big, okay?
Okay.
And that's mostly held by institutional and retail investors. That's not something that's on a lot of the banks' balance sheets. It's not something the Federal Reserve is involved in a lot. So it shouldn't have a material impact on the economy, okay? But it will cause some people to lose a lot of money.
I also noted that the country of Afghanistan that we just got out of has a lot of the minerals that we need.
Sure.
A whole lot.
Sure.
In some
Sure.
We might have thought twice about getting out of there so quickly because China controls about over 90% of the rare earths, which are not rare.
Sure, and we have a lot of those rare earth minerals here in the U.S., but the clean energy people won't.
Yeah.
The climate people won't let us mine them. Okay.
Mine them, I know. We have them, but it's expensive to mine and it's dirty and it's
exactly right. It'll never get done. They'll regulate it so it never can happen. Just like they've regulated, that you can't build a new refinery or a new pipeline or drill a new oil well.
One of the things that I learned, going back to when we had the crash of 50% in one day, is that if you're in index funds and you just put your money, and as the market goes down, if you want to put a little bit in each index fund, the index funds come back, whereas individual stocks may or may not. And so as long as you're patient with it, good index funds, the S&P 500 or a healthcare index and things like that, it takes a lot of the risk out of the investing over years, and that's
right.
Very hard
diversification helps mitigate risk. You're absolutely right, Steve. Be diversified, and I think all of us have our retirement monies well diversified. We should. Yeah. So you got a good mix of U.S. stocks and foreign stocks and bonds, well diversified. But you can have a little mad money on the side too.
Yeah, you can play around, but if you pick 3 stocks and 2 are winners and the third one wipes out everything you made with the 2 winners.
Yeah,
it's hard to do.
There's more what they call idiosyncratic risk if you own individual companies. You got to be careful.
So indexes, I've learned, is a very good way to invest in all of this.
Other questions from anybody? Anybody else have any other questions or other comments? This is a discussion, okay?
Yeah, I do.
Go ahead.
Yeah, we're talking about the auto stocks. I was reading that the average auto on the street now is like 13 years old.
Right.
And I know that, I mean, I've got one that I got a 2005 and it runs fine, but I'm just thinking that, you know, how long is the car supposed to last if it's, and I just think that the car stock has got to come back sometime if the cars on the road are that old, or there's got to be something done to, you know, to lower that.
Absolutely right. Yeah, you're absolutely right. You know, the car company stocks have been clobbered because they're consumer discretionary, and that's because a lot of investors are fearful of a recession, so they think people aren't going to be able to go out and buy a new car. But that will change.
Yeah.
Okay, as the recession comes and goes. But also there are auto parts suppliers you could buy too to help keep the old cars on the road.
Running, yes.
Exactly. So you got Advanced Auto Parts, you got O'Reilly, you got there's a whole lot of companies that supply parts that should do really well. Okay. But consumer discretionary is down, just like housing. The stocks of the home builders are way down too, because mortgage rates are up. And again, a lot of investors are fearful of a recession. And, you know, during a recession, people don't go out and buy new car or as many new homes or new cars as they do when the economy is really good. I mean, that's just basic economics 101. They will come back. Okay. We just don't know when.
Another thing to think about, my cars, I ran into them at the dealership a couple of weeks ago. My car is about 11 years old, but I don't drive it a lot. I've only got about 80 some odd thousand miles on it. He said, keep your car because we're not getting any new cars. Now, I don't know if that means no new cars or just very, but they had used cars on their showroom floor.
I believe that.
Actually,
Remember,
a year and 2 years old.
Yeah, new cars today are just computers on wheels, and they need a lot of chips. And there's a chip shortage like everything else. So they got to wait for the chips to get produced so they can put them in the car so the cars run. That's part of the problem why car prices are up so much. That's because there's the supply issues. They can't make enough cars to meet the demand.
Yeah, I recently just traded in my 3-year-old car, and they paid me just about what I bought it for 3 years ago.
You got a good deal.
Yeah, I mean,
what the new car cost you?
If you ever want to trade a car, you'll never get deals like this in your life because they need the cars because they have no new cars on the lot. So
that's right, and they can take the chips out of the old cars and put them in the new ones.
At one time, they wouldn't sell you a car unless you had one to trade in. Not too distant past.
I'm not surprised by that. Let's see. Any other questions? Sheldon, you've been very silent. You always have a comment. What's your comment, Sheldon? You're on mute. You're on mute, buddy. You're on mute. There you go.
Can you hear me now?
I can hear you now.
All right. My sage advice is to hold on to cash.
Cash is good in a down market.
Cash, yeah. I think we're in uncertain times, not only nationally, but globally. And anything can happen. And it's good to have cash available.
Yeah, that doesn't mean sell, guys, that does not mean sell everything you have now, okay? That means just have a little cash on the side.
Yeah.
Right?
I'm talking about covering a couple of years worth of expenses.
Yeah, having some cash is always good. Take advantage of opportunities.
That's my only input because it's so uncertain what's out there that play it carefully.
All right, let's see. Who else has? Harvey Gerstein, you always have comments. What do you think? You're on mute, buddy.
John?
Yeah. So I had a question. The Congress passed this multi-billion or trillion-dollar infrastructure bill.
Right. Go ahead.
In one case, that's adding to the inflation. On the other case, I just drove from St. Louis. I'm in Delaware right now, and the highways are in atrocious condition. I was on the Pennsylvania Turnpike. It is it's terrible. And we need that. We need this infrastructure. That's just the highways, and the bridges. I understand everybody talks about are even in worse shape. It's a no-win situation.
So let me tell you.
It's going to take a while to get those projects approved because they got to pass all the environmental regulations.
So I'll tell you a unique highway story that just got final input on it, or some input on it, this morning, just before we went airwise. My son he flew to Bozeman, Montana to go to Yellowstone, and it is flooded there. The highways are not accessible. So the only way he's chartering a flight for him and his family to get back to St. Louis.
Oh boy.
That's the highway conditions out in West right now because of the rain. Don't go west.
Yeah, don't expect all those infrastructure projects are not shovel ready. Remember that term?
You got it.
They're not shovel ready yet, and it may take a while for them to get done, especially when they have to pass all the new environmental regulations.
We desperately need it, and somebody's sitting on it.
You betcha. Other questions?
I don't want to end this with a sour note, and that Sheldon's right. Most analysts say hold on to your cash, but and I'm sure you do know, the average person does not have more than $400.
No, you're absolutely right.
I don't like to end it with a sour note.
Well, Marilyn, let's end it on a positive note.
Hi, Sheldon. Yeah, you should hold on to your cash if you've got it.
Well, Marilyn, here's the good news. No one in this network is average. I'm sure everybody here is well-heeled and has at least 10 years worth of cash around.
That's right. We're all legends in our own minds.
All right.
Any other comments, guys? We're getting close to the end here. We got 2 minutes left.
I've got one thing to say. I can tell everybody how to make a small fortune in the stock market. You know how you do that?
Start with a large one.
Yeah.
On that sage advice, we should probably stop.
Guaranteed.
Mike, thank you for your input.
Thank you so much.
You're very welcome. My pleasure, guys. We'll do this again next quarter, okay?
Yeah.
Because I'm sure we'll know more. Or maybe.
Yeah, thank you again, Mike, for speaking with everyone. That was an incredible presentation.
That's great, guys. This is a lot of fun. I enjoyed very much.
Thanks, Mike.
All right, guys. See ya.
Okay.
Bye-bye.
Bye-bye.